Hello there, students. Today, we're going to learn the difference between a stock and a bond. That's right, bond. Financial bond. The secret agent that's there to help your money grow and accumulate. So financial bonds, what are these things and how are they different from stocks? Well, a stock is when you actually own a piece of a business. It's true. Think of your favorite business, whether it's a phone that you have in your hand or something that you eat that you really enjoy. You can probably go on the stock market and buy a very small ownership share of that company. Another word for this is equity. You'll have equity in the company. You'll be an owner. But as a result, there are certain risks involved. In a stock, if it goes bankrupt, you lose everything. That company doesn't owe you anything if they go bankrupt. Now that's in stark contrast to a bond. In a bond, if you invest in a company's bond, that means you're investing in their debt. They are legally obliged to pay you back, and they'll give you interest. So let's come down to the board to explore these differences. So again, a stock is an ownership share. And it's sometimes referred to as equity. A bond is a legal obligation to repay. It's also a type of debt. So bonds have certain features. They have a maturity. That's when they have the payback period. So if a bond had a maturity of 2022, the year 2022, you'd say the maturity of the bond, it becomes due in 2022. They also have interest rates. That's the annual payment to the bondholder. And that's you. If you invest in a bond, then you're going to get a certain amount of interest every year. The final thing that we want to look at here is yield. This is the rate of return for investing in a bond. A lot of students get interest rate and yield mixed up. So what we're going to do is magically lift this red magic carpet to reveal a problem to illuminate the situation. That's magic. On the 3rd of June, you purchase a $1,000 bond at 90 cents. That's financial lingo we'll get to in just a second. With a 9% interest rate and a 2031 maturity. Okay, so this doesn't come due for quite some time. So if you spend your $1,000, you're not going to get that $1,000 back for quite some time. However, you are going to make 9% per year. But the one thing that I want you to take away here is that it was purchased at 90 cents. So what does that mean? That's financial lingo. So if you're a trader, you'll say, yep, I'll have that one at 90 cents. I'll have that one at 95 cents. I'll have this one at 75 cents. And you trade and you're like, oh, I'll take this one, that one's mine. That type of verbiage, cents, means cents on the dollar. So 90 cents means that you purchased a $1,000 bond at 90 cents on the dollar. A dollar's 100 cents. So this is like saying 90 out of 100. To make this math a little bit easier, we can just say it's 9/10. To make this math even easier, we can just say it's 9/10 as a decimal. All right, so 1,000 times 9/10 is 900. So what's really interesting is you got a pretty good deal on this bond, relatively speaking, because it was initially issued at $1,000, but you were able to buy it at a discount, $900. Why? Well, just like with stocks, bonds prices fluctuate. If a company is doing great, then perhaps it would be selling at 105 cents, right? You have to pay a premium to get that bond. If the company's looking like it's teetering on the edge of bankruptcy, then people are going to get really scared. They're going to be like, I know there's a legal obligation to repay this debt. But they might not be able to because they're going through all their cash. Management's terrible. The product's terrible. I think this business is going to go bankrupt. You might want to sell, and that's going to depress the price. So $900 might be a good deal, but it could also indicate that the company's financial health is deteriorating. But let's just look at this problem as is, because we don't have any other information. You purchased this for $900. Now, it is true that there's a 9% interest rate. But that's not the yield. The yield is not 9%. Because this is actually going to make you even more money, because you got a discount paying for it, but you're still going to get 9% on the face value of the bond. So I'm going to put down this last term here. Face value is the issue price of the bond. Issue price. All right? So it was issued at $1,000, and you're going to get 9% on the face value, which is $1,000 per year. So what type of yield are we looking at here? Well, to understand that, let's take 9% of face value, which is $1,000. So 9%, that one might be hard for us to do in our head. Let's do 10%. 10% was when you divide by 10. So if I divide 1,000 by 10, I'll get 100. But I didn't want to divide it by 10. I didn't want 10%, I wanted 9%. So if it's not 100, it's 90, right? So 9% would be really close to 10%. So you think, oh, I have 100, but I want 9%, so I go down to 90. So this is going to be $90 you're going to get every year in interest on the face value. But the thing is, you only paid $900 for it. So to find the yield, you take the interest rate, or the interest paid, excuse me, and you divide it by the price paid. Okay, so the interest rate, give ourselves a little bit more room here above. The interest paid was 90. The price paid was 900. And that's going to be our yield. So let's simplify. Tens will divide out. 9 goes into 9 and 90. So if we divide both these by 9, we'll get 1/10, which is the same as 10%. Okay, so the yield, you're actually making more yield on this. The rate of return on this bond is actually a lot higher, from 9% to 10%, because you got a discount initially, right? You didn't pay the full face value on the bond. You got a little bit of a discount, and that increased your yield. Your rate of return went up. You were able to buy low and still get that same 9% interest rate on the face value. So what is a bond? A bond means that you're going to purchase that investment, and whoever you purchased it from, whatever company, is going to have to pay you back in the future. It's like a legal obligation to repay. They have to. And you can yield more on a bond or less on a bond depending on whether you buy below the initial purchase price or above the initial purchase price, which is called the face value. This is in contrast to a stock, where you don't have a legal obligation to repay as a company. If you own stock and then the company goes bankrupt or does really poorly in the market, you could lose a lot of money. So bonds typically are a little bit safer of an investment. Thank you very much, and have a great day.